Hey, Jason here. Today's video, we're going to continue going over our analysis of Widepoint, going through its financial statements. Specifically, its 10K. We're going to continue going through that. Before I get to that, though, I need to let you know you can get this series as a podcast anywhere in the world for free on all major podcasting platforms: Stitcher, Anchor, SoundCloud, Spotify, iTunes, and more. You can get this as part of the I Love Value Investing podcast anywhere in the world for free. If you like this video and our other videos, make sure to subscribe, hit the notification bell so you're notified every time we release a new video, and we release new videos all the time. Okay. I'm not going to go through this today. We'll see what happens in the comments. But I'm not going to do my normal disclaimer because this is, I think, part 3 or 4 now of this analysis of Widepoint. If you want to see the other analysis videos, make sure to check the description below. They will be there. Today, though, we're going to continue going through the 10K of Widepoint. And I'm going to show you what you see on the right side of your screen here are my notes. I'm showing you the exact process I do when I take notes on a company, so you can learn it. So, okay, let's get my face out of here. Let's not do that. Let's try this so you can actually see things. Okay, there we go. You can actually see things. Okay, so we left off at page 11 last time. We're on page 12 today. And again, if you didn't watch our last video, I'm going to go through these. I usually read these word for word, but today I'm going to scan these and let you know of any major things I see in either a positive way or a negative way. I'm going to explain to you what's going on, why these things are of my interest. But when you do this yourself, you should read these word for word. I still read these word for word when I analyze stocks myself. The reason I'm not doing that today is, frankly, that'll probably bore you to death. Okay, so here is more notes and companies they work with. Lockheed Martin, Northrop Grumman, 2 gigantic companies in the federal defense contractor space. Oh, these are larger competitors, actually. These are not, it says competitors up here. These are, I was scanning ahead. These are not companies they work with. These are competitors. So that goes into things of note. Again, if you want to see how I set this up, make sure to watch the last video, which you can get for free below. Okay, this is important. We prefer to serve as the prime contractor when we win a contract awards. However, we will often serve as a subcontractor and partner with a large systems integrator to win a larger market opportunity. Why is that important? Because if they want to be in control, essentially is what that means. Let's go up here. But when they're not, they'll work with other people to get bigger contracts. That's also important because people who are the prime contractors, typically not only are they in control, they typically make more of the money as well. So that is important to know. That they do both. Business is not seasonal. That's not important for most businesses. If it is, that's when I would add it to the notes. But it's saying it's not seasonal. Because of that, I'm not going to add it to the notes because that's for the same thing for most businesses. Again, I know this here. However, our revenues and operating results may vary significantly from quarter to quarter due to revenues earned on contracts, number of billable days in the quarter, timing of the services, all that. Again, if you didn't see the last video, I explained that I grew up in a military family. My dad was in the Air Force for 21 years. So I'm very familiar with these kinds of government contracts and how they work. So I'm not going to add this to my notes. However, if you didn't grow up in that space and this is something important to you, that's something you should probably know and add to the notes. Sorry, that's my dog in the background. I apologize for that. Hopefully it's not too loud. Okay. Huge amount of regulations. This is what I talked a little bit about this in the last video. In my opinion, this can be a competitive advantage. Most people would see this as a competitive disadvantage. I see this as a competitive advantage because the more regulations, the more taxes, the more kind of hoops to jump through, bureaucracy and stuff like that, the fewer people are going to do it because, frankly, not only on top of that because it's a pain, but you also have to have security clearances typically to get these kind of contracts as well. And those are, I wouldn't say they're necessarily hard to get, but you have to go through a huge vetting process. And I think last time I looked, it was like 15 to 25 grand to get a security clearance. So that in and of itself is a competitive advantage because a lot of people and a lot of companies will not go through that. Again, I know this. If you do not, I would add that to the notes. Federal government audits and reviews our performance on contracts, pricing practices, cost structure, and compliance with applicable laws, regulations, and standards. And then goes on from there, what happens if they fail those inspections. Essentially, they can be fined, suspended, and kept from doing business as a government contractor. Okay, this is more of a note than anything. It's not really good or bad. It's just a note. Their number of employees for those who are watching on the podcast. And again, if you're watching on the podcast, as I said in the first video, where we actually digging through the financials here, I'm not going to read everything word for word, so I apologize for that. I'd point you to the, this is something very visual. So I'd point you to the YouTube channel for this if you're listening on the podcast, if you want to know every single detail that I'm kind of going through. Again, why am I not saying that every single word? Because it would probably bore you to death. So I apologize for that if you're listening on the podcast. This is interesting. This whole thing is interesting. The average tenure of their employees is 7 years. And 1/4 of their employees have been employed for more than 10 years. That means that people generally like working for them. That means they have a lot of experience. That means they have people that are probably loyal to them to some degree. I view all of those as good things. Now, the opposite side of that is if there are a lot of entrenched people and they're not helping increase value and things are getting stagnant, that could lead to problems. But for the most part, I view that as a positive thing. Okay, address. This address, or these addresses, specifically, this one, our principal executive offices are located at this location. I would want to know this if they own that building. Why? Because if they own the building, then I can go find what this building is worth based on tax records, and then compare that same building to other buildings to find an estimated fair value, estimated market value of that building. That's important when we get to the valuation stuff, not necessarily important now, and frankly not important at all if they just lease it. COVID pandemic, you see there's risk in a lot, sort of the risk factor stuff now. Every time I tell my students, every time we get to this section with one of our masterclass students, I always say the same thing. These are quite boring to read. Typically for most businesses, they're pretty much almost exactly word for word the same at every single business. Because of that, I read everything word for word, but I will at some times look for specific things, like if there's something that is worded completely differently than what I've seen at most other companies. And I don't know if we'll see an example here, but one example is that I've seen quite often, or relatively often. So to me, the big thing here is to watch, make sure everything should sound relatively similar. If it doesn't, I'll point it out and to something I've read before. And if it doesn't sound familiar, I'll point out why that could be a potential red flag, depending on what it says. Okay. COVID pandemic. Yes, you see this a lot. That's not super important. It's just kind of common knowledge at this point that if there's high unemployment, global supply chain issues due to COVID, it could impact the business. You see this a lot. We operate in a market that is highly fragmented, price sensitive, and subject to fierce competition. This is interesting, not necessarily a bad thing. This to this. Talking about pricing pressure, reduced sales, shorter term lengths, their competitors offering lower prices, and this could have an effect on margins. That's interesting, not necessarily a bad thing. Oops, this is still up, so I apologize for that. But I want to put it in here just to be reminded of it more than anything. Many of our competitors have greater financial resources. You'll see that a lot in here. May not be able to respond to rapid technological changes. Again, very common. Okay, we want to read this one because this talks about specific customer contracts and then a specific how a loss of significant customer contract could be a bad thing, and then it talks about a specific contract, so we want to read this whole thing. Okay. So they have one contract here. If they lose this, it doesn't say, most of the time you'll see on here could or would or should have a material adverse effect on our operations. They say here, accordingly, the loss of a significant customer, particularly the DHS CWMS 2.0 IDIQ contract, I'm adding that, would have a material adverse effect on our operations. So we'd want to watch for that. Another thing to look for up here, we estimate that the loss of any large contract with annual managed service revenues of more than $1 million without offsetting could have a significant adverse effect on our cash flow and financial results. We would be likely to face with the decision to initiate additional cost reduction actions that would likely include reductions in force for personnel and assets affected by the contract loss. So if they lose contracts, which again makes sense to me, but the specifics here are what are more important, especially the wording here. Would. Again, usually it's could, maybe, should, those kind of things. This says would have a material adverse effect on our operations. Okay, again, I know this because I know how government contracts work. Our sales cycles can be long, unpredictable, and require considerable time and expense. If you don't know that, you would want to add that to the notes. Again, very common. Our financial resources are limited, and a failure of one or more products or services could materially harm our financial results. That's very common. Again, I know this because of being in this arena. If you do not, we have significant fixed operating costs, which may be difficult to adjust in response to unanticipated fluctuations in revenue. If you do not know that, you should add that to the notes. Okay, I see something. Credit facility expires in April 2021. If they can't renew that, that's a problem. Now, it's past April 2021, so we can just research that. I'm not going to now, but that's something we want to know. Did they update the credit facility? Did they increase the credit facility? What happened with the credit facility? What are the terms? Blah, 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 blah. We want to know all that. Okay. This is common in smaller companies. We have had a history of losses and we may be unable to sustain profitability. You want to read this, again, you want to read this entire thing, this entire 10K, but this one specifically, you want to read every single word. Make sure you understand everything. And I'll highlight here what specifically catches my eye. Although we achieved profitability in 2020 and 2019, we have a long history of losses prior to 2019. So what I would want to know here is going back to 2019, what changed 2018, 2019 to lead them to profitability? Is that sustainable going forward? Was there a major shift in the company? Was there a major contractor? Is that one single contract they're talking about a couple times now, which I can see it down further below? Again, is that the only reason they're profitable? If it is, are you comfortable with the risk of having one contract essentially lead to that profitability? Those are the kind of things I think through when I see something like this. Okay. Again, there's the contact down here, or the contract, the IVIQ DHS contract. Okay, again, I know this part about the penalty, or without penalty in canceling contracts. If you do not add that, this is what's interesting down here. This contract, or this set of contracts, well, we need to figure out if this is one contract or if it's a set of contracts. But this one contract or set of contracts makes up 36% of overall revenue and 33% of managed service revenue in 2020. So you need to note that in the notes as well. Do more research on that. When did that contract come in place? How long has it been in place? What are the kind of terms, if they talk about the terms at all? How long are they expected to be in place going forward? All that stuff. Okay, this is pretty standard as well. This is interesting. Most of our customer contracts have terms of 3 to 5 years, with 4 option periods I see below, depending on the needs of the agency. So we want to know with that DHS contract, is it just been renewed? Is it just about to be renewed? If it's just been renewed, that takes away a lot of the risk, because it's guaranteed essentially, unless they do something stupid or the government just decides to yank the contract for 3 to 5 years. If it has 6 months left on the agreement, that puts a lot of risk on the situation, because the company may not get it renewed. They probably will, but that puts more risk that they might not as well. Okay, this is pretty standard. Loss of key personnel, blah, 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 blah. That's very standard. You'll see, again, this section almost line for line in most other companies' 10Ks. This entire section, line for line, these paragraphs, these big paragraphs, you'll see that almost line for line the same. Again, I know this about minimum service level stuff. If they aren't able to meet a certain level, a certain standard agreed to in the contract, they can get the contract taken away. If you do not know that, then I would add it to the notes. Expanding sales solutions to customers outside the U.S. Their long-term success depends on that. All these, I mean, are risks for any company going outside of where they're located geographically. To me, the biggest one is cultural issues. Okay. Expansion into international markets could require us to essentially spend more money and have more concerns about privacy, all that stuff. Again, very common. We may be unable to successfully acquire complementary businesses, services, or technologies to support our growth. So it looks like they want to grow, at least in part, via acquisition. That's not really good or bad or even anything of note. That's something that many companies do. So it's not really anything super important or news to me. Again, if you're just starting out, that might be something to you. A competing solution to their TM2 solution could reduce their business, of course. Again, same thing here, just worded differently for the most part. If a communications carrier prohibits customer disclosure of communications billing and you stated to us this could harm our business. And again, I'm not reading these word for word. I'm just kind of summarizing what these main points are saying as we go over these. Okay, this is fun. This is one of my favorite things to talk about because nobody else talks about it. It'll be a massive competitive advantage. Or not a massive competitive advantage, massive informational advantage. Okay, net operating loss carry forwards. These can be extremely valuable things. What are they? Net operating loss carry forwards. They're also called NOLs or tax credit carry forwards. These can be viewed as tax credits as well, depending on the jurisdiction. These are things worldwide where if a company loses money, they get a tax credit for the amount. In this case, it is $36.1 million in federal and $36 million in state. That's important. I'll tell you why in a bit. But first, what are these? Okay. What are NOLs? Again, they're the tax credits. But so what does that mean in a real world sense? If a company loses money in a given year, let's say it loses $1 million in a year, just to use even numbers, it can get it, or it's going to get a tax credit for $1 million. It can then use that money if it becomes profitable the next year to offset that year's taxes, which means if they choose to use the full amount, they wouldn't have to pay up to $1 million in taxes in the next year. These can be extraordinarily valuable if the company has lost a lot of money over a long period of time, and they build up over time, and the unprofitability builds up, and then the company becomes profitable. These can make it to where companies literally won't have to pay taxes for years, potentially. In this case, the company is $36 million. Let's go What is the size of the company? I think it's under $80 million, but I can't remember the number. Okay. Oh, okay. So this company has a market cap of $57.15 million as of this recording. They have $36 million in federal net operating loss carryforwards. They have $36.0 million in net operating loss carryforwards at the state level. That is important because where these are earned, as in where the company loses this money, the jurisdiction, in this case, city, state, or country, federal, in the United States, state, I don't know what state they're located in. There's also city NOLs as well, but those are pretty or reasonably rare. That's for bigger cities. I think New York City is maybe the only city I've seen that from. But what that means is, for example, if this company expands overseas, let's say they go to the UK and England, they cannot use these NOLs to offset profits in another jurisdiction. So these have value, extreme amount of value in this case, 36 million compared to 57 million. And this isn't the final number. I'll show you the final number, where to find that below. But these can be incredibly valuable. These can add enormous value to the company because, again, it could mean, in this case, literally years, they might not have to pay taxes. I've seen companies with hundreds of millions of dollars of NOLs that added enormous value to the company because they were unprofitable for a long period of time. Then they became profitable. There are a couple caveats to these. If these can be enormously valuable, but only if the company is either approaching profitability or is currently profitable after long periods of unprofitability. These have no value whatsoever if the company is unprofitable and has been for a long time and they show no signs of becoming profitable. They have no value whatsoever because the only time you can use them is when you're profitable. The other downside to these is they expire. Depends on the city, the state, the country, the location. Typically these can last up to 15, I think it's 20, 30 years typically, but you want to see when these expire. So to talk about that, I'm going to search deferred tax because these are where they show up in, there should be a little chart at some point in here that talks about deferred taxes and shows the full amount. Tax assets, that's not it. What happened? We'll get to all this in time, but this is not what I'm looking for. This, the start of this is what I'm looking for. So deferred tax assets, they go into more detail further below. They are showing that they used 9.711 or $9,711,726 in deferred taxes for net operating loss carryforwards in 2020. They used $10 million in 2019, so that means they offset those years' taxes by that amount. This is not the chart we're looking for, though, because this is not the final number. Okay, here we go. So there's usually that little chart, and then there's this, where it shows you, as of December 31st, 2020, the company had approximately $36.1 million in net operating loss carryforwards available to offset future taxable income for federal tax purposes. Net of section blah, blah, blah. These NOL carryforwards expire between 2021, so this year, and 2036, which is a long time from now. Including the recorded deferred asset, the company had benefit of approximately $36 million available to offset future taxable income for state income tax purposes. These state NOL carryforwards expire between 2024 and 2036. Okay, and yeah, what it's talking about next is if generally if there's a change of ownership, there's a merger, there's a sale to somebody, something like that, then the NOLs become useless in most cases. Okay, see down here. These are valuation allowances. What you want here is this number. So 36 plus 36.1, so that's $72.1 million in total NOLs, state and federal. They can't offset. That's bigger than the entire company. They have a market cap of 56 million. They have total NOLs, state and federal, of $72.1 million. That means they have more NOLs than the entire company is worth. Let me bring my face in here because I think we're going to go back up, and that's where we're going to stop because this is an important point that I want to hit. Where were we at? I want to get back to my spot though before we. I don't think we're there yet. Okay, so we ended on page 21, the bottom of page 21. Okay, let me bring this back. Bring this back. There we go. Okay, so I've liked this company from the beginning. What these do is this means this adds an enormous margin of safety to the company because it increases their value. How does it increase their value? Again, this offsets their taxes. So let me show you that. I'm going to bring this up on my other screen because I didn't expect to talk about this. So I don't have it up, but I'm going to show you what this kind of means in a real world sense. Because I think it's on the income statement. They show taxes. If not, it's on the cash flow statement. I can never remember where exactly taxes are put. Okay, tax rate. Let's see it there. So you can actually calculate this out based on their previous numbers, how long these NOLs will potentially last. That's not finding it anywhere. So let's go back over here to there. 10K. And we want the income statement. And I'm gonna show this as soon as I get it up. It's taking me a little bit, so I apologize for that. I'm actually gonna pause until I get it back up. Okay, so I found it, and it is. They had before these NOLs, they had income before income tax benefit or provision. That's a confusing sentence. However, what they did use is they used almost $4 million in 2020 for their benefit. What is their benefit? In this case, it's the NOLs. So they used 7.4 million of their NOLs last year. So at that rate, they have just under 10 years, like 9 years of NOLs where they might not have to pay taxes if they continue at a current rate. This can be spaced out further. So for example, let's say they have 72 million in total NOLs. Let's say they have earned profits of $80 million next year. They could say use only 10 million of that if they wanted to offset part of it. You don't have to use the whole thing to offset the full amount. But you can only offset up to the full amount, but you don't have to use the full amount. Hopefully that makes sense. But what that essentially means is the company may not have to pay taxes for a long time, and that money can instead be used to grow the company, grow marketing, do better grow sales, acquire business, develop new products and services, all that stuff. They can use it internally instead of paying taxes. I'm not here to say whether that's right or wrong. But it is a thing, and this isn't just a thing in the U.S. This is a thing worldwide. This is, I think it's in pretty much every country I've ever researched, maybe in some of the countries I haven't researched, but every country I've ever researched, and it's been a lot, I've seen these things that can be incredibly valuable. So another way I'd like to put this is the company may not have to pay taxes for, let's say, 5 to 10 years at their current run rate. If used properly and they reinvest this money well, this could add, in other words, $72.1 million to the company's value. Again, the entire company value right now is $56 million. So this could more than double the size of the company if they use the money well. That's the key point, though, is if they use the money well, if they allocate capital well, if they invest well, if they train their people, do marketing, all the stuff we were talking about. They do that well. This can add an enormous amount of value to the company. What this will do when we get to the valuation, which is still a little ways down, is this will increase the value of the company for my calculations. Why do I say it that way? Because most people, again, do not read financial statements, do not read annual reports, do not read proxy reports, do not read quarterly reports. So they don't see stuff like this. I apologize for my dogs right now. I don't know what's going on. They don't see this stuff. You can gain a huge legal informational advantage by knowing what this kind of stuff is, what it means in a real world sense, not just what it means in a book sense, but what it means in the real world sense, and how much value this can add. Again, for this company, realistically, and I'm going to discount these for the reasons I talked about, like they're expiring soon, so they might not use all of them, they might become unprofitable. I'm going to discount them in my valuation, so I'm not going to count the whole full $72 million. But a portion of this will add to the company's value, a pretty substantial amount. By my guess, I usually use 25% when I do use these, so 25% of 72 is, don't feel like doing that in my head. So again, just off the top of my head, and we'll get to this in the actual valuation part, 72.1 times 0.25, that's $18 million, which is 18 divided by 56. That's an extra increase in the value of the company by 32% on top of what it already is based on their balance sheet and their operations. So hopefully this makes sense. I haven't talked about this before, and the only time I really talk about this is with students. So hopefully this makes sense. If it doesn't, let me know in the comments below. But we're going to stop here because this video's gone long because I wanted to explain this fully on the NOLs. But if I didn't explain something well enough, if I should explain something better, if I didn't explain something at all that I should have, let me know in the comments below. Again, especially when it comes to NOLs, you can get a huge legal informational advantage by knowing what those are, properly evaluating them, properly valuing them, and adding to the value of the company. Enormous value. Again, I've seen some companies with hundreds of millions of dollars of these that people didn't know about. If you're watching on YouTube, thanks so much. Make sure, we really appreciate it. Make sure to like, love, share, comment, subscribe, and hit the notification bell. We really appreciate all that, but make sure you hit the notification bell so you're notified every time we release a new video, and release new videos all the time. If you listen on the podcast, same stuff. Really appreciate you listening. But on the podcast, we'd also really appreciate a review, because the more reviews, views, and listens we get on our content, the more people we can help. If you want me to evaluate stock like this for you, let me know in the comments below. Every stock I've done for the last 3, 4, 5 months, and every stock for at least the next 3 weeks to a month or so, is requested from a viewer. If you want me to evaluate a stock for you like this anywhere in the world, let me know in the comments below. I am now giving preference to masterclass students. It's fully relaunched that, and I'll give some more information on that in a second, and if you're interested in that. But even if you're not a masterclass student, I will put you on the calendar and evaluate a stock. If it's not a bank, because I don't evaluate banks. If it's not an insurance company, because you actually have to dig into the 10Ks like this to be able to evaluate them, and I don't typically do that with students because most people find insurance companies incredibly boring. And if it's producing revenue, it has to be producing revenue. Why? Because I've done some videos where companies weren't producing revenue, and because at the early stage of my analysis, which is usually the first video that I do on a company, I don't care about the company's story. I don't care about what it does. I don't care about what it says it's going to do in the future. I don't care what its future prospects are. If they're going to be the next Amazon, if they're going to be the next Uber. I don't care. Even at this stage that we're at today, which is my third and fourth stage of analysis that we're doing today in the going through the 10K, I don't care generally. Because of that, though, the company has to be producing revenue, which is why, again, those videos were pretty boring because there was no numbers to evaluate at my early stage. If it meets those criteria, let me know. Again, I'll look at a stock anywhere for you in the world. If you're looking for more help on how to become a better value investor, make sure to check out some of our free resources below, including our 5 free gifts, which you can get actual full analysis worksheet that I use every time I evaluate a stock that we showed, I think, in part 2 of this Widepoint video, which you can see below. You can get 4 other free gifts as part of that as well. That will help you become a better investor faster. You can also get a free copy of our guide, 7 tips to picking your great stocks and 3 times you must sell. And you can also get a free copy of my book, How to Value Invest, a free PDF copy. You can get all 3 of those resources for free at the links below. If you're looking for more specific help from me on how to become a better investor faster, make sure to check out the information on our newly relaunched masterclass. Just relaunched as of this recording a couple days ago. We've already got some students in, already in talks with other students. We'd love to have you in there. If you want more information on that, you can go to the links below as well. But until next time, have a great day. Talk soon.